Hey everybody, it's Jonathan Dugan. I'm here with my friend Dawn Connors. She's with Mortgage One, and I've been doing these expert videos, and she graciously said she would come in and talk to us a little bit about mortgages. Being that I sell real estate, I'm not a loan expert, but I know a lot about it. But sometimes people ask me questions, and even though I have a mortgage and I help people get a home bought or sold, I don't always know the ins and outs. So Dawn has graciously agreed to come in. She provides great service to our community, to all my clients, and we're just going to ask a couple of questions today and try to help you out in understanding mortgages. So, you ready? I'm ready. You're
I'm ready.
All right, so one of the big things I always get, and I think people get a little bit confused about, is they'll see an interest rate list and they'll see a column that says interest rate and then a column that says APR. What is APR? What is that? What's the simple? Is there a simple answer for what that is?
Sure, I think so. So an interest rate is the actual interest rate that your payment is calculated off of. That's your interest rate that you can expect. An APR, the purpose of it is to allow you to do shopping around with other lenders. It stands for annual percentage rate. Annual
Okay.
percentage rate.
Annual percentage rate. Okay.
And what that is, it's the cost of credit over time. So what it's trying to tell you is, given your closing cost, it's as if you paid that interest rate year one because of the closing costs factored into the loan.
Okay.
So the APR is always going to be higher than the actual interest rate because it's trying to give you closing cost as a percentage along with your actual interest rate.
Okay. So it's factoring in all your costs to close the loan, not just the interest on the loan itself.
You got it.
Is that correct?
Yes. So things like the interest that you pay when you first close on the loan, the appraisal, an underwriting fee, a title closing fee, that would be factored into APR.
Awesome. Okay. I feel like I understand that better. Thank you.
Yes, my pleasure.
All right. So we learned a little bit about APR, and now one of the big questions I get is about points. And we're not talking about, scoring a basket, hockey,
Craps?
Craps, no, not craps.
We do not want you
Grade.
gambling with your mortgage,
Yeah,
so this is not craps.
So when it comes to points, and when people are figuring out points for their mortgage, what are they doing? What does that mean?
Sure, great question. So points are a fee that you pay if you choose to buy your interest rate down. It is a fee that you choose to pay to get a lower interest rate,
Okay.
especially on a primary home or a second home. We'll talk more about interest rates and buying down when you're buying investment property.
Okay.
So let's say you have a 740 credit score.
Which, good for you.
Good job. And you have a $100,000 loan amount.
Okay.
And the interest rate is 4.25% without points.
Okay.
Should you choose to buy a point, that would cost you 1% of your loan amount, or $1,000.
Okay.
And that would gain you a quarter point off the interest rate. So from 4.25 to 4%.
Oh. Would you actually save money doing that?
Good question. So you save about $20 a month, let's say, and it costs you $1,000. So if you take $1,000 and you divide it by 20, that will tell you how many months it takes you to recoup that point that you paid. Generally speaking, it takes about 5 years to recoup 60 payments to recoup any points that you pay, at least 5 years. So if that's the case, then it's generally not worthwhile to buy points unless you're going to live in the home, I would say, greater than 8 years, and you feel certain of that, and you don't plan to do any refinancing or financing that will change your current loan situation.
Okay.
And you can buy more than 1 point. You could pay 2 points or 3 points. Let's say you paid 3 points or $3,000 and you wanted to get down to an interest rate of 3.5%. If, as a general rule of thumb, that should get you down to 3.5%, barring market conditions and exactly what the buy down is.
Okay. So that's it's a way for you over the long term to get a cheaper interest rate, but it's fair to the mortgage company because they are still getting some of their
Upfront
Upfront
money,
money.
and you're getting you're getting an interest rate below market value.
awesome.
Yeah.
Okay. Well, that's cool.
Mhm.
So, not this,
Not this.
but this. All right. Well, so Dawn, we've learned a little bit about APR. We're getting some inside baseball on points, and now let's talk about getting qualified for a loan. My experience with you is that you're a very kind and generous human being, and very helpful. So if somebody has decided, yes, I want to make a purchase, what are some best practices for them to make sure that they can have a good shot at qualifying
I like that.
for a loan?
Okay. Rule number 1. You do not want a quick and dirty pre-approval. What do I mean by that? You don't
What do you mean by that?
you don't just want a resource where you can go online, spend 10-15 minutes inputting information, and it spits you out an approval.
Okay.
The reason for that is if you can do it and get an approval that quickly, then a lot of Joes can do the same thing.
And James.
And Jacks and Jills.
Yeah. All right.
And when that happens, the issue with that is that the probability of somebody not being able to qualify is greater than someone that's been vetted well with the seasoned loan officer.
Okay. All right.
So rule number 1 is you want to work with a seasoned loan officer who requires you to give you their documents.
Okay.
So the documents that you're going to need to prepare yourselves for are pay stubs. 2 is good. 2 months bank statements. 2 is perfect. 2 years W-2s. 2 is perfect. Your ID, and that should do it. If you are self-employed, you will also need tax returns. Preferably, you got it,
2.
2 years. So once you have those documents together, you're going to want to get those to your lender. And your lender should not only input information into your application that you can do online or that they can input for you, but they should also review your documents and make sure that they match to the application.
Okay.
Run your loan for approval and then issue you a pre-approval letter and talk through numbers with you so that you know what your payments would look like and your out-of-pocket would look like.
Okay. So, not to disparage any lending plants that are online or large trees or anything like that, but you want to try to get in with a loan officer.
Or rockets that can blow up in your face.
You want to get in with a loan officer such as yourself, and you want to think twos, right? So you want 2 years of, 2 pay stubs, right?
You got it.
2 months bank statements,
Perfect.
2 years taxes,
Help me now.
and if you're self-employed,
That's when you need the tax returns.
you need the tax. You need 2 years W-2.
Yes!
Okay, all right,
Boom.
and then 1 ID.
That's right.
Unless you're married.
Yeah.
You probably need. So think twos.
Yep.
Well, I think that's very informative and also gives me another reason to sit with you in the future and we can address some of the things we missed
Great.
and dive deeper.
Great.
And like I like to say, leave a comment, subscribe, send me your questions. Dawn or I will direct you to Dawn and she can help you out. And what do I like to tell people on my videos? Be good to your neighbor. We're all neighbors. All right? So I hope you're out there having a good day. Peace.
Bye.
Bye.